Hey everyone, and welcome to this explainer. Today, we are diving straight into the wildly interconnected web of global events. We live in an era where distance has basically vanished. So we're going to break down exactly how a single physical catalyst, like a disruption in a critical global waterway, creates these massive economic ripples that literally reach all the way to the servers powering your favorite apps. It is a fascinating web, so let's jump right in.
The oil shock is becoming an interest rate shock. That exact quote from our source material perfectly captures the entire thesis of today's analysis. Right now, Brent crude has surged past $100 a barrel. We're talking a jump of roughly 7% in a single day, and a monthly gain pushing 40%. But this isn't just about the price of gas down the street. It is a story about how a localized shock mutates almost instantly into a global financial event that touches absolutely every sector of the economy.
So you might be wondering, how in the world does a blockade in the Middle East end up crashing tech stocks in Silicon Valley? To make sense of how these completely disparate events connect, we have to look at the central global risk happening right now, a concept called linkage. It sounds crazy that a maritime conflict on the other side of the planet could force the most advanced tech companies to completely rethink their multi-billion-dollar AI budgets. But, as you'll see, that is exactly what's playing out.
Section 1. The Global Domino Effect. Geopolitics meets economics.
Before we get into the hard numbers, we really need to understand linkage. It's this systemic reality where a localized event moves almost immediately through global shipping, energy, currencies, and food prices. Basically, in today's economy, there are no isolated incidents. A local attack doesn't just stay local, it travels at breakneck speed through global shipping lanes, jolts energy markets, messes with currency strength, especially for developing economies with dollar-denominated debt, and eventually, it lands right on our grocery store shelves.
It's a literal chain reaction. Step 1, you have a Middle East conflict, with the Houthi movement claiming a blockade on Saudi shipping after attacks on 2 tankers. Step 2, that forces ships into massive detours around Africa's Cape of Good Hope, tightening shipping capacity. Step 3, all that extra fuel and lost time drives Brent crude over that $100 mark. And finally, Step 4, soaring energy prices spark inflation fears, which sends borrowing costs and bond yields surging.
The geographic vulnerability here is absolutely crucial. The Bab el-Mandeb and Hormuz Straits ordinarily carry roughly 25% of the entire world's oil supply, a quarter of it. With both of these waterways threatened, confidence is just plummeting that exporters can easily shift their routes. And when ships have to take the long way around Africa, they're tied up for much longer. So global shipping capacity actually shrinks, even if the physical amount of oil being pumped hasn't changed one bit.
And that brings us to the financial fallout. 5.20%. As investors bake this energy-driven inflation into their expectations, the U.S. 30-year Treasury yield recently approached a 19-year high of roughly 5.20%. The math the market is doing right now is pretty direct. Expensive oil equals higher inflation. Higher inflation equals higher yields. And those higher yields completely upend how companies and investors value future earnings. You can see the immediate, brutal reaction to these pressures across global market indexes. Higher long-term yields are just kryptonite for highly valued growth companies. South Korea's Kospi dropped 6%. Japan's Nikkei fell 2.8%. The tech-heavy Nasdaq shed 2.15%, and the S&P 500 dropped 1.24%. This right here, this is linkage in action. A physical shipping blockade halfway around the world, turning into a multi-billion-dollar wipeout on global markets.
Section 2. The New Trade Reality. Tariffs and Exclusions.
So on top of all that, international trade policy is acting as a massive multiplier to these frictions. The U.S. administration just rolled out sweeping new trade enforcement policies under Section 301, citing forced labor concerns. They are replacing expired temporary global tariffs with new 10 and 12.5% duties across 60 trading partners. Now, they did exempt strategic things like oil, natural gas, fertilizer, and some foods, but businesses are basically scrambling, having to reconcile these incredibly complex product exclusions on top of their already sky-high supply chain costs.
And to put the sheer scale of this into perspective, 99.4%. With limited exclusions, these new rules apply to countries responsible for nearly 99.4% of U.S. imports. That is basically everything. Procurement teams are pulling their hair out, trying to classify products because landed costs are shooting up, even for the companies that thought they had already adapted to earlier trade restrictions.
Section 3. AI's Financial Reality Check. The CapEx Collision.
This brings us to a fascinating collision course. High interest rates and expensive energy are crashing headfirst into the massive AI boom. We're seeing a really stark split between the hype and the reality. The hype is incredible, right? Surging revenues, Alphabet's cloud rising 82%, their Gemini model serving 950 million users. But the reality? Negative free cash flow, a massive dependency on cheap energy, and really high borrowing costs. Building the infrastructure for AI is actively draining the cash these companies need.
Don't get me wrong, the top-line Q2 revenues for these tech giants are phenomenal. You have Alphabet at $119.8 billion, Tesla at $28.24 billion, and Intel at $16.13 billion. This proves that the conventional computing market and AI adoption are totally real. The demand is there. Companies are aggressively throwing capital at this space, but here is the rub: $195 billion. Despite those massive revenue numbers, Alphabet recorded negative free cash flow and just raised the floor of its projected 2026 capital spending to a staggering $195 billion. Tesla is in a very similar situation, generating negative free cash flow because robotics, autonomy, and batteries are all fighting for the exact same expensive investment dollars.
So the ultimate question really becomes, can these ambitious AI systems earn more than the capital required to operate them? With expensive energy and high bond yields, the real test isn't about capability anymore. We know AI is smart. The test is now about disciplined deployment and actual durable profitability. In a world of 5% treasury yields and $100 oil, investors want proof that this historic infrastructure buildout is going to generate actual cash.
Section 4. The human ripple effects. Linkage in daily life. Let's bring this all down to earth, because this macroeconomic web deeply affects community health and everyday human life. Look at this sequence. Oil jumps over $100, which immediately leads to higher freight and continuous refrigeration costs. What does that mean locally? It means the delayed distribution of temperature-sensitive medicines. A shipping hazard halfway across the world eventually makes it harder and more expensive for your local hospital to get essential drugs.
And these community impacts just compound when you add in environmental stressors. Expensive gasoline restricts people from making long-distance travel for medical treatments. You've got flooding from the remnants of Tropical System Bertha, creating localized health hazards in Texas. Wildfire smoke heavily degrading air quality across the Midwest. And rising utility costs pushing companies to actually rethink their remote work policies. Supply stability, climate, and transportation are all totally interlocked with our daily well-being.
Because of all this real-world friction, the job market is actually shifting. Demand is absolutely surging for analysts who can model alternative shipping routes, calculate inventory buffers, and figure out insurance costs. While AI takes over routine tasks, the most resilient careers are the ones closest to managing these real-world physical constraints and making accountable decisions in times of crisis.
So, as we wrap up this explainer, I want to leave you with this thought. In a world of total linkage, where a localized conflict instantly impacts everything from global shipping logistics to the massive servers powering the AI apps you use every single day, who ultimately pays the price for our interconnected systems? What is the true cost of living in such a beautifully complex yet incredibly vulnerable world? Thank you so much for joining me to explore the mechanics of global linkage. Keep learning, keep questioning, and I'll catch you in the next explainer.